Crypto. Crypto is one of the most exciting and dangerous types of investment. The idea is simple from the outside. You buy digital assets like Bitcoin, Ethereum, or other cryptocurrencies, hoping they become more valuable later. But crypto is not just one thing. Bitcoin is often seen as digital gold. Ethereum is more like a digital platform where apps, tokens, and smart contracts can exist. Other coins promise faster payments, better privacy, gaming economies, artificial intelligence, or some new financial system. The attraction is obvious. Crypto can move extremely fast. A coin can rise in a way that normal investments almost never do. This creates stories of people turning small amounts of money into life-changing wealth. But that same speed works both ways. A coin can also crash, disappear, get hacked, lose attention, or turn out to be a scam. Many people enter crypto thinking they are early investors, when really they are late buyers in someone else's exit plan. Crypto rewards research, timing, patience, and emotional control. But if you only buy because everyone online is screaming that it is going to the moon, you are not investing. You are standing under a rocket and hoping it does not fall on you. Real estate. Real estate is one of the oldest and most understandable investments. You buy land, a house, an apartment, a building, or a commercial space. Unlike a stock or a coin, real estate feels real. You can touch it, walk inside it, improve it, rent it, sell it, pass it down. That is why people trust it. Real estate can make money in several ways. The property can rise in value over time. You can rent it out and collect income. You can buy a damaged property, improve it, and sell it for more. Or you can use debt to control a much bigger asset than you could buy with cash alone. That is the powerful part. Real estate lets people use leverage. A person may not have enough money to buy a full property in cash, but with a loan, they can control the asset and benefit if its value rises. But real estate is not as passive as people make it sound. Roofs leak, pipes break, tenants leave, taxes rise, interest rates change, bad locations stay bad, and a property that looked like an asset can quickly become an expensive problem. Real estate can build wealth slowly and powerfully, but only if the numbers work. Because if you do not understand the deal, the building may own you more than you own the building. Stocks. Stocks are one of the most popular investments in the world. When you buy a stock, you're buying a tiny piece of a company. That company might sell phones, software, cars, food, medicine, clothing, entertainment, or almost anything else people use every day. This is what makes stocks powerful. You can own a small piece of huge businesses without building them yourself. You do not need to run the company. You do not need to hire employees. You do not need to open stores. You simply own a small piece of the machine. If the company grows, becomes more profitable, or becomes more valuable in the eyes of investors, the stock price can rise. Some companies also pay dividends, which means they share part of their profits with shareholders. But stocks have a trap. Many people forget that a stock is not just a moving line on a screen. They buy because the price is going up. They buy because a famous person mentioned it. They buy because everyone says it is the next big thing. But they never ask the basic question: what does this business actually do, and why should it become more valuable? A stock can represent a great company, but a great company can still be a bad investment if you pay too much for it. Stocks are not magic tickets. They are pieces of businesses. And the better you understand the business, the less you depend on luck. AI and future tech. AI and future technology investing is a bet on what the world might become. This includes artificial intelligence, chips, robotics, automation, cloud computing, cybersecurity, biotech, electric vehicles, and other technologies that could shape the next decades. The reason this feels so exciting is simple. Technology can change everything. A new technology can create new companies, destroy old ones, and build entire industries that did not exist before. Someone who invests early in the right technological wave can benefit from years of growth. That is the dream. People do not just want to invest in a company. They want to invest in the future before the future becomes obvious. But this is also where the trap begins. The words AI or future tech can make almost anything sound smarter than it really is. A company can talk about artificial intelligence without having a strong business. A startup can promise a revolution while burning money. A stock can rise because of excitement, not because of real profits. Technology investing is powerful because the winners can become massive, but the losers can disappear quietly. The hard part is knowing the difference between a real technological shift and a beautiful story. AI investing is a bet on the future, but the future does not pay everyone who simply buys the hype. Gold, silver, and crisis assets. Gold and silver are different from many other investments. They do not build products, they do not hire workers, they do not create apps, they do not pay rent, they do not grow like a company. But people have valued them for thousands of years. That is why gold and silver are often called crisis assets. When people lose trust in money, banks, governments, markets, or the economy, they often run toward things that feel older, harder, and safer than paper currency. Gold is not usually about getting rich fast. It is often about protection. People buy gold and silver during inflation, uncertainty, war, banking stress, or economic fear. They see these metals as a store of value when everything else feels unstable. The strength of crisis assets is psychological and historical. They can make investors feel protected when the financial world feels fragile. But there is a weakness. Gold does not produce cash flow. It does not grow a business. It does not invent anything. If you own a piece of gold, it will still be the same piece of gold 10 years later. So gold is not really a machine for creating wealth. It is more like financial armor. It may not build your future, but people reach for it when they are afraid the present is breaking. Index funds and ETFs. Index funds and ETFs are some of the simplest investments but also some of the most powerful. Instead of trying to pick one winning company, you buy a basket of many companies at once. For example, instead of choosing whether one company will win, an investor can buy a fund that tracks hundreds of companies. This means if one company fails, the entire investment does not depend on that single mistake. The mechanism is diversification. You are not betting everything on one horse. You are buying part of the race. This is why index funds and ETFs are popular with long-term investors. They are simple, low maintenance, and do not require you to predict every market movement. But here is the problem. They are boring. There is usually no dramatic story, no overnight millionaire, no exciting chart that jumps 500% in a week. Index investing works slowly, which makes many people ignore it. But slow does not mean weak. Slow can be extremely powerful when time gets involved, the money grows. Then the growth starts growing. Then the boring investment becomes more serious than it looked at the beginning. Index funds are not exciting because they do not promise to make you rich tomorrow. They are interesting because they quietly ask a better question. What happens if you stop trying to beat the market and simply own a piece of it for a long time? Startup investing. Startup investing is one of the most exciting types of investment because it sells a powerful dream. The dream is simple. Invest in a small company before it becomes huge. Imagine getting into a company before everyone knows its name, before the big offices, before the billion-dollar valuation, before the headlines. That is why startup investing feels so attractive. You are not buying what already exists. You are buying what might exist. A startup might become the next major app, platform, brand, software company, or technology giant. If that happens, early investors can make huge returns. But the brutal truth is that most startups fail. They run out of money. They build products nobody wants. They lose to competitors. The founders disagree. The market changes. The idea sounds amazing in a pitch deck, but the real world does not care. Startup investing is not like buying a finished machine. It is like paying for a blueprint and hoping the machine gets built. The upside can be enormous because one winner can cover many losers, but that only works if you can survive the losers. Startup investing is a hunt for rare success. Most doors lead nowhere, but one door, if it opens, can change everything. Peer-to-peer lending and private loans. Peer-to-peer lending and private loans are investments where you become the lender. Instead of borrowing money from a bank, someone borrows money from investors. That borrower could be a person, a small business, or a project. In exchange, they agree to pay interest. The idea is simple. You give money today, and they pay back more later. This can feel very attractive because the income is easy to understand. There is no complicated chart, no mysterious token, no futuristic technology. It is just money being lent for a return. In a way, you become a tiny bank. But there is one huge problem. Banks spend a lot of time trying to understand who is likely to pay them back. And even banks get it wrong. If a borrower stops paying, the investment can become stressful very quickly. The promised return does not matter if the money never comes back. This is the main risk. The income looks stable until the borrower disappears, the business fails, or the platform has problems. Private lending can create cash flow, but it requires trust, contracts, risk control, and a serious understanding of who is receiving the money. Lending money is easy. Getting it back is the real investment. Websites and online businesses. Websites and online businesses are a newer type of investment. Instead of buying a building, you buy a digital asset. That could be a blog, a YouTube channel, an online store, a newsletter, a software product, a niche website, or a small internet business. The reason this is interesting is that digital assets can make money from almost anywhere. A website can earn from ads. A YouTube channel can earn from views and sponsorships. A newsletter can earn from subscriptions. A software product can charge monthly fees. An online store can sell products while the owner sleeps. This makes online businesses feel like modern money machines, but they have a hidden weakness. Many digital businesses depend on platforms they do not control. A website can lose traffic after a search engine update. A YouTube channel can lose views after an algorithm change. An online store can lose customers when ad prices rise. A software product can be copied by a better competitor. The asset may look independent, but sometimes it is quietly dependent on one platform, one traffic source, or one trend. That does not mean online businesses are bad investments. It means the real question is not just how much money the business makes. The real question is how fragile that money is. An online business can be a cash machine, but sometimes the machine only works because the algorithm is still being kind. Investing in yourself. Investing in yourself does not look like a normal investment. There is no stock chart, no coin price, no property contract, no gold bar, but it can be one of the highest return investments a person ever makes. This means spending money, time, and energy to improve your ability to earn, think, work, communicate, create, or stay healthy. It could be learning a valuable skill, improving your English, buying better tools, studying sales, learning coding, design, finance, editing, marketing, or business, building a personal brand, improving your health, moving to a better environment, getting around smarter people. The mechanism is simple. If an investment increases your earning power, it can pay you for years. A skill can raise your income. A better body can give you more energy. Better communication can create opportunities. Better knowledge can help you avoid expensive mistakes. But there is also a trap. Not every course is an investment. Not every book changes your life. Not every mentor is worth the price. Sometimes people are not investing in themselves. They are buying motivation because it feels like progress. Real self-investment must turn into action, because the value is not in the course. The value is in the person you become after using it. Royalties and intellectual property. Royalties and intellectual property are strange because they can make money after the work is already finished. A musician writes a song. An author writes a book. A photographer licenses an image. A developer creates software. A designer sells templates. A creator makes content. A company owns a patent or a brand. If people keep using, buying, streaming, licensing, or downloading that asset, money can keep coming in. That is the power of intellectual property. You are not only paid for working in the moment. You can be paid because something you created in the past still has value today. This is why royalties feel almost magical. A song can earn years after it was recorded. A book can sell while the author sleeps. A software product can be downloaded by people the creator never meets. But the hard truth is that most intellectual property makes little or nothing. Most songs are ignored. Most books do not sell much. Most apps disappear. Most digital products sit online like empty stores in the desert. Royalties are not easy money. They are delayed money. You do the work first, and only later discover if the world cared enough to keep paying. Royalties are when yesterday's work keeps knocking on today's door with money in its hand. Options and high-risk trading. Options and high-risk trading are some of the fastest and most dangerous ways people try to make money. This includes options, leverage, margin trading, day trading, futures, short-term price bets, and other strategies where the goal is to profit from market movement quickly. The appeal is obvious. Speed. A normal investment might take years to grow, but a trade can make money in minutes, hours, or days. This creates excitement. It creates stories. It creates screenshots. It makes people feel like they can escape slow wealth and jump straight into fast money. But speed is dangerous. Because losses can move just as fast, options can expire worthless, leverage can multiply mistakes, margin can force people out of positions. A trader can be right about the direction, but wrong about the timing, and still lose money. That is what makes high-risk trading so brutal. It is not enough to be right eventually. You often need to be right quickly. Some people treat trading like a skill, others treat it like entertainment. The problem is that entertainment becomes expensive when the market charges admission. High-risk trading is not automatically bad, but without rules, risk management, and emotional control, it becomes a casino with charts, and the market does not care whether you called it investing.